Hello, and welcome to the market review at myfinancesteacher.org. In this market review, we're going to have a look at the general stock market as well as the precious metals markets. Starting with the general stock market, as I mentioned several times in some of my previous videos, I think perhaps the intermediate cycle in the general stock market did finish over here in early March. That's based on the usual duration of these cycles, just over half a year. Perhaps the previous one was slightly shorter than usual at 161 days long. And looks like the decline into the intermediate cycle low back from February down into the early March was a relatively modest one, where S&P 500 only dropped by about 6% or so. And Nasdaq did drop a little bit more than that. A strong rally since then in the S&P 500 that so far has been going on for slightly under 2 months does seem to confirm that, yes, the intermediate cycle low is behind us in early March. And given that these intermediate cycles usually last for just over half a year for the general stock market, we possibly can expect 2 to 3 or perhaps even 4 months of the general upward momentum in the stock markets. So in the intermediate term, I'm still positive on the general stock market. I think we're going to see S&P 500 create new highs over the next several weeks. But in the very short term, I am still cautious, just as I mentioned in my previous video on general stock market. In the short term, these short-term daily cycles usually last for around a couple of months. And the ongoing one is near that average duration at 57 days so far. So if the ongoing short-term daily cycle comes down to the end of that cycle, perhaps to come closer to the 50-day moving average, that will be just in time for a slightly longer than usual cycle to give us another buying opportunity into the continuation of the ongoing new intermediate cycle. Notice that S&P 500 is already showing us a negative divergence versus the RSI, where the price on the price chart is showing you higher highs, whereas RSI is showing you lower highs. That is a negative divergence, and that usually comes before some sort of a decline, before some sort of a cool down on the price chart. You'll also see that in the second half of this ongoing short-term daily cycle, the price did poke several times above the relatively wide Bollinger Bands, and now the upward momentum in S&P 500 is flattening out a little bit. And over the next 1 or 2 weeks, I would expect to see some sort of a short-term daily cycle low, which, as I mentioned, will be another chance for me to re-enter into the stock market after having relatively nice profits recently for that continuation of the intermediate cycle over the next several weeks. Next, let's have a look at several interesting indicators in relation to the general stock market, starting with the CNN's Fear and Greed Index. As you see over the years, usually a nice buying opportunity occurs when the CNN Fear and Greed Index is somewhere around 30 or below. As I mentioned, the most recent intermediate cycle low in early March this year was relatively modest when S&P only dropped by around 6%, so the March low over here on the Fear and Greed Index also shows a relatively modest drop when this index did break below 40, but it didn't actually reach as low as 30. On the other hand, on the top side, usually as you see, an intermediate cycle top takes place when this CNN Fear and Greed Index is somewhere above 78. And since late March so far within the ongoing intermediate cycle, we haven't seen much greed on the markets. We haven't seen this Fear and Greed Index spike up to 80 or above. So as I mentioned, although in the short term perhaps there is a chance for a cool down over the next 1 or 2 weeks, in the intermediate term, over the next few weeks, I think we still have to see higher levels on the general stock market and more greed on the markets as well. Next, let's have a look at the optimism index on the general stock market. Usually intermediate cycle lows take place when this optimism index is somewhere around 30. But perhaps with the trillions and trillions of dollars of stimulus packages and the extra money supply being printed, we haven't really seen much corrections in the general stock markets. The beginning of the previous intermediate cycle over here in October last year brought this optimism index only down to about 55 versus the usually nice buying opportunity at the levels of 30. And the previous intermediate cycle low again is perhaps very mild, with this optimism index only dropping down from 86 down to 66. And similarly to what I've mentioned so far, over the last few days we see optimism is declining a little bit, perhaps sensing a short-term correction down into the end of the ongoing short-term daily cycle. And next let's have a look at this 25-week return, which is generally applicable to the intermediate cycle rather than short-term daily cycle. So these green triangles indicate intermediate cycle lows since late 2018. The blue line is the S&P 500, and the red line is the rolling 25-week return on S&P 500. The circles indicate the lows in this 25-week return as they correspond to the intermediate cycle lows. And from looking at these last few years, it seems to me that relatively nice buying opportunities on the general stock market do take place when this 25-week return, when this red line comes as low as 0% or lower. And again, as I've just mentioned, the most recent intermediate cycle low was with this 25-week return only dropping down to around 7 or 8%. Alternatively, of course, it could be the case that since this decline is very mild, perhaps we are still going to see a proper decline into the intermediate cycle low over the next few weeks, perhaps bringing S&P all the way down to 38, 37, but I don't really expect it, as I said, with so much help both from the monetary as well as fiscal policies. Instead, perhaps we're going to get another buying opportunity over the short term to continue riding this rally in the intermediate term. Next, moving on to the interest rates. As I mentioned last time, the interest rates were likely to retest that downtrend line as well as the 50-day moving average, which they did over the last few days. And the 10-year rates even poked above both the 50-day moving average and this downtrend line. But perhaps this breakout will turn out to be a fake breakout. Currently, we see the rates have already lost that 50-day moving average. And what I actually expect is, even if this 50-day moving average is regained over the next just several days, perhaps the 10-year rates have a chance to poke above the Bollinger Bands once or twice before they actually come down again into some of the support zones I mentioned in my previous video. Perhaps the general stock market will take this as an opportunity to come down into that short-term daily cycle low while rates are rising before continuing the intermediate rally in the general stock market when the rates drop again. Similarly with precious metals, I think those will be under pressure over the next few days. Let's move on to precious metals, starting with the US dollar. Again, as I discussed in my previous video on gold, I mentioned that the short-term daily cycle in the US dollar was getting ready to finish, giving us a bounce into the new short-term daily cycle in dollar. I don't think this rally in dollar is going to be extremely strong. Perhaps dollar will come to test this 50-day moving average, or what's more likely, the dollar will probably test the 50% Fibonacci retracement or maybe even 62% Fibonacci retracement before coming down into the declining phase of this new ongoing short-term daily cycle. And as we see from the bottom of this chart, the correlation between dollar and gold is still quite strong and negative, so a stronger dollar over the next few days, as well as stronger rates over the next few days, will likely continue pressuring gold a little bit lower. Again, last time we looked at gold, we mentioned that gold was likely to come down from that resistance zone down into this 38, 50 to 62% retracement, closer to this 50-day moving average. And gold did actually do so, coming this Thursday low at about 1756. I mentioned that I wanted gold to retest these recent highs at around 1760. And what do I see so far? The ongoing short-term daily cycle in gold is now 56 days old. Usually these cycles last for anywhere between 1.5 to 2 months. So I think over the next few days, still during this week, gold is likely to continue a little bit lower, closer to this 38%, perhaps even 50% retracement, before the new daily cycle in gold starts, continuing that rally into the ongoing intermediate cycle, which perhaps started over here in early March. Next, let's have a look at the optimism index in gold. Looks like Early March lows at low 40s on the optimism index were low enough for the intermediate cycle low, and the most recent correction over the last few days is likely to continue to give us another buying opportunity on precious metals to continue into this new intermediate cycle lasting so far for a couple of months. However, there is also a bit of a chance that the intermediate cycle in gold starting in late 2020 didn't actually finish over here in early March this year. Before we break above this resistance somewhere around 1800 to 1815, a continued decline into perhaps still an ongoing intermediate cycle will still be on the table, because usually these cycles last for about half a year. The previous cycle in gold lasted for unusually long at 155 days. So to bring the average cycle duration back to normal, perhaps the cycle did actually last for much shorter than usual at about 100 days over there between late November and early March. But that is a very unusually short cycle. So as I said, the possibility of considerably lower lows are still on the table if the cycle continues for its usual duration of just around half a year. That would give you an intermediate cycle low sometime into late May, early June, before a proper rally really starts into the new intermediate cycle. So I would give this scenario perhaps a 40% chance at the moment, but a more likely scenario in my opinion is that we have been in a new cycle since early March, meaning that gold is likely to continue cooling down just over the next few days before another attempt to break above this resistance. And I would give this scenario perhaps a 60% chance. Talking about the likelihood of these intermediate cycles, let's have a look at the 25-week return, which is often useful in identifying these intermediate cycle lows. Looking at the last few years, the triangles indicate intermediate cycle lows in gold. Perhaps there is a new triangle over here in early March, giving us a relatively short intermediate cycle over here between November and March. And the circles indicate the levels of this 25-week return corresponding to those intermediate cycle lows. So looking at the last few years, it seems that a nice buying opportunity on gold usually comes when this 25-week return, the red line, is anywhere around 5% or below. And looking at the most recent potential intermediate cycle low in early March, it looks like there is a nice opportunity for a strong rally, as this 25-week return was pretty low all the way down at -12, -13%. It's actually even lower than it was back in August-September 2018 after this long and patience-testing decline into that intermediate cycle lows. I remember I did get a lot of comments about this painful decline from the viewers on my channel. By the way, if you like this video, remember to hit that like button, subscribe to the channel, and hit that notification bell so you don't miss out on some of the interesting buying opportunities coming up soon. For now though, I wish you a productive Monday and good luck in your trades.